and a warm welcome. You joined us on Commodity Central right here on ET Now, and it is that day of the week where we go back to the basics. And in this week's weekly edition of Commodity Classroom, we delve into some aspects of India's commodity market. How big is it? How big is India's commodity market? And can you actually trade in commodities? What regulations govern India's commodity market, and how stringent are these rules and regulations compared to rest of the world? To decode this, we are now joined by Mr. Kishore Narne, Head of Commodity and Currency at Motilal Oswal Financial Services, who, remember, has been tracking the commodity market for over 2 decades now. Sir, thank you so much for taking your time out and helping us joining us on here on ET Now. But first up, help us understand how big really is the commodity market in India versus the rest of the world. Can you help this decode for our viewers?
I think Indian commodity market is pretty small compared to the rest of the world. Actually, globally, commodities market is categorized in a very different manner than what we do in India. So, for example, in US, all derivatives are categorized under commodities, including equity derivatives, index derivatives, weather, even for that matter, currency derivatives is also categorized under derivatives contracts, and which are commodity derivatives contracts, and is regulated by CFTC. And the entire equity cash market, which is primarily regulated by SEC. So typically that's how the regulation and the structure in US works. In India, SEBI is a unified regulator for the entire capital markets and derivative markets, at the same time commodity markets and whatever the instruments which are tradable. In India, it could be index derivatives, it could be commodity derivatives, everything.
And sir, if you can help us understand who are the primary participants in India's commodity market who actually are involved in commodity trading?
Again, we being a primarily equity driven investment as an investment class, commodity markets in India doesn't really form a part of as an asset allocation strategies, or even it's not the part of many portfolios of either retail investors or even for the larger clients or even family offices. Because the fund participation is pretty much new in these markets, and the global client participation, that's what we call foreign portfolio investors or FPI's participation, is very restricted into non-deliverable commodities. Only a couple of commodities are allowed for them. So the institutional participation, so-called the large client participation, is very much restricted due to the regulatory hindrances and all. So primarily this market is driven by smaller hedgers. Again, they form a very small part, and predominantly individual retail traders or HNIs, whatever so-called directional traders, is the primary participants in this market. So that's the reason why Indian markets are so small in commodity segment. The recent relaxation and recently SEBI allowed FPIs to participate in non-deliverable commodities. They also allow domestic mutual funds and domestic AMCs to offer products with commodity derivatives as part of their funds. So some catching up is going on, but I think there's a long way to go as far as size of this market is concerned.
Thanks for putting that into perspective for us, but also help us understand and compare liquidity in Indian commodity market versus equity markets. Can we actually trade the way we do in equities, and is liquidity high enough to trade in commodity futures?
Indian equity market, again, on a broader numbers, trades around 60 to 70,000, maybe 75-80,000 crores kind of a cash market turnover, maybe under a lakh crores, and around again roughly 70,000 crores worth of premium turnover on the derivative side, on the options front, as predominantly Indian derivative markets in equity side is predominantly dominated by options. So if I have to compare in the similar manner, the premium turnover on the commodities exchanges is close to around 2,500 crores roughly premium deployed in the market, versus around 70,000 crores in an equity front. So it's 35 times smaller than the equity markets, but that doesn't mean the liquidity is not available. So compared to equities, yes, liquidity is shallow.
India's commodity market is 30 to 35% smaller as compared to equities, is what you are telling us. But in India, which commodities have highest liquidity?
70% or more of that liquidity is concentrated in one commodity, that is crude oil. So that makes it much more liquid enough, as the liquidity is not sparsely dispersed among many other commodities. So other commodities like gold, natural gas, and silver are picking up on their option liquidity, but crude oil definitely leads the pack. Today, the notional turnover on the exchange close to around 3 to 4 lakh crores on an expiry day, maybe a couple of days before expiry, and on average around 2 lakh crores one-sided, single-sided volume on the exchanges is a pretty much decent liquidity for any trader to participate. I have not encountered any large client at this point of time who is actually suffering from liquidity, are not able to execute their transactions because the liquidity was not available. But I think it's more relatively the size of the customers. And as a market, when you say that, I think less than 3% or even less of the total the clients or total investors who are participating in equity markets are participating in commodity markets. So it's hardly 2 to 3% of people participating here. So for them, the liquidity is enough. As more and more people participate, as it increases, it also will drive the foreign portfolio investors and the domestic funds to come on with a greater might and more fund allocation, which will actually enhance the overall liquidity. So at this point of time, I don't see a liquidity issue, but if you compare the market, yes, it is much more shallow than the commodity, than the equity markets.
Commodity market is much more shallow, but there's no problem as far as liquidity is concerned. That's the word coming in. But taking a leaf from what you just said, you just spoke about commodity regulations. Are regulations tougher in India versus other countries, and how do regulations for commodity market vary across geographies?
Regulations in India, I cannot say tougher, but they are very much in parallel to global markets. There are a couple of stark differences in regulating in commodity markets in India. Again, I'm walking a tightrope here. SEBI is primarily an equity regulator who has been assigned to regulate commodity markets as well. So there is a little bit of learning curve which is going on there also, and the understanding of the commodity markets is to be developed. Number one. Seeing that, actually, at the same time, SEBI has a very, very positive outlook on the market. They want to develop this market. They want to give the much needed support through a positive regulation to this market. So that intention is very well demonstrated by SEBI many times in the past. So a couple of issues will remain. That one is that uh, because of the way the margins are calculated in commodities market at this point of time, the short option margin on the option sellers is not very favorable. It is not similar to the equity markets. Here, the hedge benefits are not there. When you have a hedge positions or a counter positions, you might not get the hedge benefits similar to that. So that actually makes you to invest more money than what is required, or it's much more risk tighter at that point of time. So you can say that it's a slightly tighter risk management. Number one. Number two, yes, we have seen a negative settlement on crude oil during the COVID time, and actually that still has a bit of overhang on the total of margin charged for many of these commodities. So still we charge far higher margins on commodities. Yes, it makes it safer, definitely, for the members as well as the exchanges. The system is much more robust. It has much more title margin these things, but it is a little bit of deterrent also to some extent for participation in commodities.
And since you are talking about margin money, I have a follow-up question. Are margins in commodity trading higher as compared to equity trading? Help us understand the difference between the margin money that you have to invest.
When we're looking at global markets, the margins are charged differentially. So for a hedger, if you are a hedger like, for example, Hindalco participating on aluminum, or some other company, Hindustan Zinc participating on zinc, as being a hedger, recognized as a hedger, generally in global markets, the hedgers will have a much lower margin requirement, because they are actually bringing more liquidity, much more solid liquidity, and encourage the hedgers to come onto the market, opening up that segment. In India, the differentiation is not there. So either you're a hedger or a speculator or a directional trader or even an option writer, you're all treated similarly and same margin norms are applicable. So as a regulator who wants to invite hedgers into the market, I think we should be considering a differential margins, where if there is a value chain participant or a hedger coming up with an underlying commodity, there should be some relaxation on maybe on the margin front, which will not add risk to the system in the holistic manner.
Sir, thank you so much for taking your time out and helping us understand several concepts related to commodity market. We'll slip into a short break on that note, but coming up on the other side, newsroom, don't go anywhere.